Next, there's no goodwill. There's no bullshit asset on the balance sheet. I always think of goodwill as a big fugazi. It's not real. It's a n'importe quoi, and it can get written down anytime, and it could be a bad surprise. Hey everybody, welcome back to the Bliss Life. Today, I'm going to be talking to you about Palantir. I'm going to be continuing this series of the bear versus bulls. Today is the bull presentation. I've had a lot of fun putting this together and I am very excited to share it with you. So let's just get straight into it. And if you haven't watched the bear series yet, then I'll put a link in the video so you can check it out before you check this video out about the bull series, because I think it's important for you to consider all sides before deciding, buying, selling, holding, or waiting on the sidelines. So without further ado, let's get started. All right, so I think it's worth saying that this is a qualitative analysis. I am not going to be doing a quantitative analysis of where I think Palantir is going or what I think Palantir is worth. If you want to see that, you can definitely check out my DCF that I did, the bullish and moderate and bearish video. That will give you a good idea of what I think Palantir is worth and the potential of Palantir based on certain assumptions. Now, this video is really just about Palantir, the business, why I think it's worth investing in my opinion, why I like the stock, and where I see Palantir having real strengths and being able to use those strengths to keep catapulting it forward. All right, so the number one takeaway from the bull analysis is that management has been growing revenues in a thoughtful manner. They've been growing the company by solving complex problems in real world situations, and they've always had a singular focus on coming up with innovative solutions to these complex problems. And whenever they come up with these solutions, it's not forgotten. It's not buried with the customer. Oftentimes, these solutions get carried forward as future product solutions for other new customers. Now, keep in mind, Gotham was founded in 2008. Foundry was founded in 2016. So in 2009, the revenues were at 16 million, which we see here, and they were able to grow to 1.5 billion in 2021. So this is a huge growth of nearly 100x in 11 years. On top of that, the revenue growth year over year has always been in the double digits throughout their history of delivering services. Now, the only issue is around 2017-18, where they had a bit of a challenge. But then as they approached the $750 million mark, getting closer to the $1 billion revenue mark, they were growing at 25%, 47%, and now 40% to finish at 1.5 billion. So this is huge. And it cannot be understated that this was being done not by hiring 1,000 salespersons, but more by doing real problem solving and offering real solutions to businesses or government institutions that were going through a real world crisis. So this is a huge takeaway, and you have to give it to management for being able to stick to their plan, their vision, and continue to grow the business the way they wanted to, as opposed to selling out and just hiring a bunch of salesperson to sell one cheap product that doesn't offer any versatility or flexibility and that cannot really be adaptable. So that's the number one bull point that you absolutely need to take away. And now let's go to the second one. So the second point is really that Palantir is targeting its customers in a tactical way. It is not just simply hiring 1,000-person sales force, like I mentioned in the last point, and just pushing a mediocre product down people's throats. What Palantir does is really target complex problems, which it learns from and it adds to its modules going forward. It's targeting disruptive SPACs. So think about Black Sky and Sarcos Robotics. Black Sky is now a customer, but also part of the Meta Constellation offering that Palantir gives its clients. Sarcos Robotics is another solution where they're introducing robotics in the workforce, which could eventually become prominent enough that it can impact supply chain. So if Palantir is offering customers supply chain visibility, and there's Sarcos robotics that are starting to become dominant in this space, then there's going to be a synergy of data that Palantir can offer its customers that most other people cannot see. There's innovative startups that Palantir is involved in, from Station F in France and also Foundry for Builders. There's the industry partnerships and platforms. So I'm thinking about Airbus and Skywise, which Palantir mentioned has gotten them $300 million over 5 years. There's the semiconductor partnerships, the heavy industry partnerships with Mitsubishi, and also don't forget the IBM and Amazon Web Services partnership. So all of this is being done to build a strong foundation for the company, a strong foundation of customers that are there for the reason that they want to be there, because Palantir has proven that it can offer substantial value. It is not a gimmick product that a salesperson pushed down your throat that you will eventually abandon to go somewhere else because there is a better product now. Palantir is a suite of products that offers real value. Now, I've been hearing it a lot, and I touched on this before in my bear video, is that Palantir is buying revenues. Palantir is so desperate that it's buying revenues from these disruptive SPAC companies. But the truth is, and this is the truth, as much as you want to hear it or not, they're not buying revenues. Palantir is investing in SPACs, check, but the ownership in these SPACs are less than 0.00%. So what this means is that for every dollar that Palantir is putting into these companies, it's buying back revenues. So if it puts $1 to the company and then that company signs an agreement, that dollar that's coming back to Palantir, from that dollar, there's less than 1 cent that belongs to Palantir. That's what this means. And I've done the analysis already. If you've been following my SPAC series, you would see that over here, we see that Palantir invested these much shares out of these much shares that the company already has in circulation. That represents less than 0.00%. So what this translates into is $1,000 that Palantir is buying back from itself. And the total deal that it got from these clients is $640 million. So Palantir has $640 million in investment agreements, but it's buying back from itself less than 1,000 or about 1,000. So all this to say is that $640 million in investment agreements that it has is funded by the other shareholders of these SPACs, and not in any material way Palantir. So this argument to say that Palantir is buying revenues does not hold ground. It's not true. The next point is that, Palantir has always targeted complex problems with large governments and large clients, large customers. So I'm thinking of Rio Tinto, PG&E, L3 Harris, Airbus, the US government and their branches of different governments. They're not targeting a small restaurant chain or a small boutique. Those are not Palantir's target customers. So that is something that you need to understand, that Palantir is targeting customers in a tactical way with purpose, because this is the foundation of the company going forward. And these customers have influence on their own networks and can eventually start to create a ripple effect where many people start to use Palantir Foundry. Now, let's go to the third point. Palantir's business model is very unique. It focuses on 3 stages, which is acquire, expand, and scale. What all of these stages do is it creates a very sticky product offering to Palantir's customers. Acquire really just means that the Palantir is in the pilot phase. It's focused on allowing the customer to learn what Palantir Foundry has to offer. And many times it's being done at the cost of Palantir. And this is where Palantir kind of excels, because many people are afraid to take on this type of risk where a customer can still say no at the very end of the pilot phase. But Palantir is big enough, has a strong enough cash position, and can gauge that this customer is interested enough to pursue this pilot project. And then eventually when they sign, they go into the expand phase, where the client is generating interest and generating leads for Palantir to see if there's any other problems that need to be solved, where Palantir can offer more modules and expand the work streams for the customer, expand the work streams that Palantir is involved in. Now, if we look at how they define the expand phase, they define it as customers with more than 100K revenues, but it's still negative contribution margin, because Palantir is still trying to, get them into trying different things. So overall, it is negative. But this phase usually does run at a loss, but it's to drive future revenues. The acquire phase obviously is running at a loss, and the margins are always negative. An interesting point that Palantir brings up is in the Q3 2021 financial statements, that they talked about the December period, the December 2020 period, so last year's period. And they said that expand phase customers were generating $20 million in revenues with a negative contribution margin of 159%, or a loss of 30 million. So they were losing more than they were generating. But then those same customers in the current year were generating $62 million with a gross margin of 28 million. So suddenly they went from losing 30 million, they caught up on that 30 million, and they made 28 million. So it was an improvement of almost $60 million in 1 year for those same customers. And now in the future year, when they're in the scale phase, it's just going to be more gravy for Palantir. That is the scale phase. So in the scale phase, investment costs really do decline in relation to revenues, and value delivered to customer increases as usage increases across operations. So in this case, revenues are higher than 100K, and the contribution margin is also very positive. So in the financials here, they spoke about it a little bit. They said in the 2020 financial statements, in that period, the 1.1 billion revenue generated from the scale phase was with 63% margin. However, by the 30th of September, so 9 months now, those same customers were generating $1 billion with 64% margin. So what took 12 months to generate 1.1 billion is now being done in 9 months, and with a slightly better margin, or the same almost. So this really does show that Palantir's module of acquiring, expanding, and then scaling does lift revenues, does lift the contribution margin. And this is a sticky business model that Palantir can pull off, because Palantir is able to set aside cash to invest in those customers, to have these forward deployment engineers to go to the customer site to understand what the customer needs. And this is not new. This is done for major ERP implementations as well. ERPs like SAP take sometimes a year to implement. I've implemented them, so I know. The fact that Palantir can implement its software from hours now, but then start to work with the customer and identify other work streams and see where people can really work in a holistic way, it creates value for the customers and obviously revenues for Palantir. Now, if you look at this business module and then you look at the average revenue for the top 20 customer, this was from Q2 2021. You could see in Q4 19, the average revenue was 25 million. It went up to 39 million in Q2 2021. And now we're at 41 million in Q3 2021. So the stickiness is undeniable. And the fact that Palantir is able to expand and scale allows us to really gain comfort that Palantir is developing a solution that works for the customer and not a cookie cutter solution that the customer can just easily disregard. All right, so the fourth point is the 7 moats. What does a moat mean? I've never heard of this before. Well, let me tell you. Warren Buffett best describes it as a competitive advantage. Simple terms, what that means is, you're protected. You have this nice armor. No one can hurt you. No one can touch you. No one can take your market share. Or imagine you have a nice little castle and people are trying to raid your castle, but they can't because you're surrounded by water. You have a 40 feet high stone castle and you're there on top sipping a beer with your slingshot because nobody's coming up there to get you. So that's what a moat means. Now, in what way will we analyze these moats for Palantir? Well, there's a book written by Hamilton Helmer called The 7 Powers. And what it does is it breaks down the 7 powers for the successful business strategy. And I'm going to take these moats and apply it to Palantir. So in this case, let's first start with economies of scale. Initially, you think Palantir has 0 economies of scale because they lose money during the acquire and expand phase. But the truth is, during the acquire and expand phase, what Palantir is really doing is that it's learning its customer, investing its customer, and during that phase, they're determining what are the outputs. But once the outputs are determined and they know what the customer needs, then everything is gravy. In the scale phase, the contribution margins are north of 60%, and Palantir is laughing. No matter what the customer wants, how many people use the service, Palantir already has developed the solution and the revenues keep increasing, but the costs will stay the same or go lower, which means the contribution margin increases. So this is how Palantir achieves economies of scale. It's not the traditional way that you would think, like in a factory where okay, I'm building 100 units of a chair, but now I'm going to build 10,000 units, so the cost of materials go down because I get a better deal. So economies of scale. It doesn't work like that. It's more so learning of the customer and then the deployment, and then it's economies of scale. And then the secondary effect or the secondary economies of scale would be when the customer, a new customer, wants something that another customer already has. So, Palantir is in the utilities game. And in utilities, it's already saved a customer millions of dollars within the first month. When other utility companies hear about this, they want the same solution. But now Palantir really doesn't have to reinvent the wheel. The solution already exists. So the Palantir's economies of scale just continues. The ripple effect continues. So that is a huge. And here, we could see that a small little point that I thought is worth mentioning is in 2 days, one of the largest banks in Europe with more than 10,000 branches deployed an end-to-end anti-money laundering and compliance process in Foundry in 2 days. And it's not because Palantir is super fast and, they are, but that comes from their previous experiences with other financial institutions. So that this economies of scale, it can be scaled across many customers in the same sector because the learning process, the problem solving costs have already been incurred. So this is where I think economies of scale is a strong 8 out of 10, maybe even a 10 out of 10, but I'm giving it an 8 because it's just not in the traditional way that people think of economies of scale. All right, so Moat 2 is the network effect. Network effect simply means that the product becomes more valuable as people use it. Palantir specializes in this, and we all know that because of the 3 phases I mentioned before: acquire, expand, scale. In the acquire phase, Palantir is there to attack the problem. In the expand phase, Palantir is there to attack other problems and help the customer solve other issues that they may be experiencing. And as the customer sees these values and the different work streams start to get involved, then it might become that, okay, well, it's not just the supply chain team that's using Palantir Foundry. Now it's the finance team that's using Palantir Foundry to generate claims with their suppliers and to say, well, supply chain was late by 5 days because your product didn't arrive on time. That meant I had 10 people late, not doing anything, and that represents $10,000 for 5 days. Supplier, I'm charging you $10,000, and it just all happens in a seamless way instead of 5 meetings over 3 weeks to get to the same conclusion. So this is what I mean by network effects. And in the investor relations of 2021, we do see that there was an example that they gave where a financial service customer, it initially started with one single use case, but then Palantir Foundry was expanded to 70 work streams, to 70 different teams or 70 different data flows where compliance, front office, risk, and internal controls or internal audit teams were all involved. So this is huge. This is what we mean by the network effect. And the value of the network effect, in my opinion, is I also see that it's like a ripple effect, right, across the industry too. So in Q3 2020, in the pre-R, we saw that there was an energy super client that deployed Palantir Foundry in hours, and they were able to save $57 million a month, which was about 1 billion annualized. Now, the network effect of this is that other people will start hearing about it. And when other industry players start hearing about it, they need to get on the boat. They need to get on the same Palantir Foundry boat. And that way they will all be able to save these monies. So that is the second moat. And I give that a 10 out of 10 because Palantir is 100% doing that. All right, so Moat 3 is counter positioning, and counter positioning simply means being open to continue to invest, innovate, even though it might come at a cost to your own business, to your own cash cow. A great example of this is when, this is me thinking out loud, but it was when Netflix and Blockbuster were both in the game at the same time. Blockbuster used to be an actual physical store, and they used to have people coming into Blockbuster to rent DVDs, to rent movies, to rent video games, buy popcorn, and all that good stuff. And Netflix was had vending machines placed in different locations, but they also got into starting to send people CDs, DVDs to their house. So what happened was eventually Netflix pivoted towards digital media, digital deliveries, and Blockbuster disappeared. And why did that happen? Because Blockbuster was like, oh, I don't need to become innovative. I don't need to do these little things like vending machines or sending stuff straight to people's homes, because my cash cow is getting people to come inside my store. So by doing that, they doubled down on not innovating because it was a risk to their current business model, but now they cease to exist. So that is what counter-positioning is. And when it comes to Palantir, I think their continuous focus on innovation and growing and offering solutions allows them to look past this idea that, oh, what we've invested so much into, it can't be abandoned, and it can't be abandoned. We can't develop something else. Palantir is able to see the bigger picture and continue to march towards that. And why do I say this? Because before they used to have a focus on cybersecurity and strictly cybersecurity. And instead of pivoting away from that, instead of doubling down in cybersecurity, what they did was they pivoted away and they started to develop other solutions, which was Palantir Foundry. And that Palantir Foundry, I bet you, I've never seen it myself, but I can bet you $1 million that it does still include the cybersecurity feature in there, but they didn't just focus on cybersecurity. And that's what I'm trying to say. They can realize when things need to be done differently, and they could continue to do that. And that comes from the management's thought process and management's vision. So that's very important. So Moat 4 is switching costs. And switching costs is exactly what you think. The more valuable, the more embedded the product becomes in the company, the more it's used by different people, the harder it becomes to switch away from it, to leave it. And why is that? Because A, why try to fix something that's not broken? B, implementation costs money. C, there is change management involved. So that means you have to retrain people. You have to run two systems in parallel for a long time to make sure that people can stomach the switch. And D, maybe it might not work. This new solution that you're trying to put in place might not work because what you have in place already works. Why are you going to try to pivot away to save a few dollars? So that is a big issue for customers who are deeply involved in Palantir. It was mentioned before that the top 20 customers of Palantir have been with Palantir for 6.6 years. And this number, in my opinion, is only going to keep getting bigger and bigger. Now, you might be thinking, okay, well, why did Home Depot leave Palantir in 2016 or 2014, many years ago? And the storyline behind that is that Palantir was giving Home Depot a cybersecurity service. So it was purely cybersecurity because they got a major online attack where all their credit card information got stolen. So Palantir got involved, helped them determine what the scope was, where was the loss, how much loss potential they have with credit card information. And then they got a new VP for VP Tech or CTO. And that CTO was like, oh, we're paying a lot of money for Palantir. 5 million a year is a lot of money for security services. We can find a cheaper solution. And that was it. But why did they switch so easily? Because Palantir was just offering a cybersecurity solution. Offering cybersecurity solution is very easy to pivot from one company to another. But now today with Palantir Foundry, where they do the acquire and expand and scale phase, they're not just offering the cybersecurity solution, they're offering many other solutions that the client needs, and then it becomes very difficult to switch. So this is why Palantir has continued to grow its Foundry repertoire and now has over 300 modules, which can really add value to customers because it makes it so damn difficult to switch. And some people call it the vendor lock-in, where you really are locked into Palantir and you can't pivot away because now you have become very reliant on them. What makes things better for Palantir is that the customer doesn't have to change a thing. If the customer is on SAP, no problem. If the customer is on another ERP, no problem. Palantir has the fix and is able to integrate. So that is a big moat, and I think that people do not realize this when they're investing in Palantir. And on top of that, what they don't realize is that as the business grows, if they're starting to install or use new softwares or new platforms for their operations, in more cases than not, Palantir Foundry is able to integrate to those different data streams. So it makes it very hard for Palantir to be canceled. Palantir can't be canceled. You can't cancel Palantir, and this is a challenge for internal IT teams who try to develop their own patch solutions. As the business grows, the VP of tech has to realize, or the CTO has to decide, like, do I keep reinvesting my team's time into developing patches as the business grows, or should I have them focus on front-end solutions that drive growth? And more often than not, if the VP is leading a huge firm, they will make the decision that generates value because they know Palantir Foundry is going to be easily adaptable to their growing business, which makes switching very, very, very hard. All right, so the fifth moat is branding. Branding is self-explanatory, but it's something that I would say easily recognizable. It creates value, it creates meaning. It does not have to explain itself to you. The way it's being described here is though it's social proof and information advantage. Humans are influenced by what they see and what others do and approve. And I feel like Palantir is really struggling in this area because it has one thing that's really going for them, which is their reliability, their credibility, their reputation on the field with government institutions and executing results. And then it has the other side, which is the PR of the Palantir brand, which is that they're a dark spy firm funded by the CIA, and they're doing evil things to trump on your civil liberties, is what people say. But at the end of the day, we all know that Palantir is a company that owns zero data. The customers always own their data, and customers choose who can see the data and has access to determine who can control, who can see, who can manipulate the data. And Palantir helps its customers determine these roles and gives them full access to a variety of tools to do just that. So this idea that Palantir is an evil firm is absolutely not true. Now, that being said, appearance is sometimes everything. It's either in fact or in appearance. So if they say you're a spy tech firm, but you're not a spy tech firm in fact, but in appearance you are, then the damage is already done. And this is where Palantir is struggling in a commercial world, because there's a lot of customers that I am sure do not want to disclose that they're working with Palantir or using Palantir Foundry. And it is because of this branding. And people are so loud on the internet that things can get out of control very quickly for a firm or a Fortune 100 firm or 500 firm to manage that kind of PR. So Palantir is really suffering in this point of view, in my perspective, and they really need to step it up. And when I say suffering, a 6 out of 10 is suffering for me. They have incredible reputation with the government, and they have a well recognized security clearance with the US government, and they hold one of the top security clearances as of Q4 2020 amongst all their peers. So, or peers in this industry, in the tech industry. So all this to say is that Palantir has a strong reputation, but sometimes in appearance, if people are saying this, that, and the other, and that works against you, then you have to get ahead of that. And I know that Palantir is actively doing that, but the question is, will they win that battle? Because sometimes the people with the loud microphones have a lot more free time to just keep yelling, as opposed to a business that has a business to run. So they are facing challenges here, but this is something that I think they need to improve on. Their branding is just not there. When you think of Google, people just say, oh, Google, it's cool, I use it every day. But Google probably collects more data on all of us through our search results, our phones, and many other services that maybe we don't know about. And the same can be said for other companies like Amazon, which, Amazon is a great company, but Amazon also does have a lot of data gathering abilities through Alexa, and there are other tools that they have sitting around in your home. So these are all things we have to think about, and we have to manage. All right, so the sixth moat, which is a important one, is cornered resources. Does Palantir have preferential access to resources that other people don't typically have? So this means licenses, patents, and talent. And by having access to these resources, are they gaining more power, more momentum? And I believe that Palantir does have the world's most talented people working there, the most talented engineers. And Alex Karp says this a million times over, that one of the main reasons why they even went public is to retain these talents and to be able to help build the image of Palantir, because by staying private, they weren't really getting involved in the public domain and trying to curate their image in a public way. But now that they went public, they're able to do that. They're able to curate their image. They're able to share some of the big clients that they work on, the interesting things that they're doing, and how they're solving many crises around the world. And all of this happens because you have these very intelligent, thoughtful engineers who comes to Palantir to solve real world issues, to solve complex problems and real world issues. They have like a sense of purpose, and they're getting well compensated for that too by having publicly traded shares, which they can eventually sell as these options vest for them. So that is a key point. The fight over talent is very, very real. Furthermore, based on their 2019 prospectus, we know that Palantir has a lot of patents. They have over 475 US patents, over 500 worldwide patents, or patents around the world, and they have over 800, I believe, that are pending patent applications. So this is a big deal, and these patents are going to expire from 2020 to 2040. And these patents obviously give Palantir the power to do things in a certain way that others cannot. So these, I do believe, are very important resources, and Palantir is doing well at that. And the last moat is the process power moat. This is when an organization commits itself to a set of activities or a system which enables it to deliver superior and low-cost product service. And that means they achieve process power. Now, where I think Palantir really succeeds is that they do deliver a superior product. However, it might not always be a low-cost service until it hits the scale phase. So this is a unique situation for Palantir, but we do know that Palantir does, as Alex Karp said, has a fanatical fixation on data integration and data protection. It's always dedicated to improving its product offerings and offering better solutions to its customers. Keep in mind, Palantir has invested billions of dollars. They have a deficit of $5 billion. Of that spend, a large portion of it has been going into solving real-world problems, real-world crises, and offering solutions. And all of these this R&D spend or problem-solving spend results in a real product that is a module in Palantir Foundry or in Gotham. All of this said, combined, you could see that there is a strong process power at Palantir. Now, when you look at these 7 moats, you realize that Palantir has a strong competitive advantage. Whether it's the network effects where the offerings have a ripple effect throughout the organization or throughout the industry, whether it's the counter positioning where they continuously invest in innovation, even if it might come at a sacrifice of something else, they're continuously investing. The switching costs are very high for customers. When Palantir gets in, scales, it becomes a vendor lock-in situation where Palantir is offering an excellent product, and for the customer to switch, it just becomes impractical. And Palantir has very good economies of scale once they hit the scale phase, and top talent. So all of this combined allows Palantir to march forward to where they want to go, which is to offer the best solutions to its customers, generate value for its customers so that they can achieve their goals, whether it's institutional goals or government institutional goals. So this is huge. And I think this is something that we can't understate, and you can't capture this in the financials right away, because the financials are a lagging indicator of all of this. All of this is being developed since the last few years, and as Palantir scales with its customers and expands and starts hiring sales force, this is when you start seeing the power of the moat. All right, so you knew that I couldn't finish a bull argument without getting to the financials, as I am a numbers geek. So we're just going to look at the Q3 financials, and I noted some comments here, and I'm just going to run it through with you, and I'll let you touch on how you feel, and drop a comment if you think I'm saying something funny or if you agree with me. So Palantir, based on the Q3 financials, remember Q4 is coming out February 17th, today is February 6th. They have a strong balance sheet, and the financial statements, overall do highlight a path to growth and a path to profitability, and I'm actually very excited about it. You just have to tweak a few levers, do this and that, and you'll hit profitability quite quick. So first takeaway from the balance sheet, without a doubt, is that the company has a very strong cash position of 2.4 billion, and its current debts right here, it's about 200 million together. They have 10 times the amount of cash needed to settle all of these debts that need to be paid within the next 12 months. Next, there's no goodwill. There's no bullshit asset on the balance sheet. I always think of goodwill as a big fugazi. It's not real. It's a n'importe quoi, and it can get written down anytime, and it can be a bad surprise. So when companies overpay for something, it usually goes into goodwill. Obviously, a rational person doesn't overpay for something unless they see great value in it, which is why there's goodwill. But sometimes I think companies do overpay because they're caught up in a rat race, and they're on an acquisition spree, and they buy things that are not worth what they're worth, and it sits as goodwill. And then when the company bombs, then the goodwill's written off. So there's no goodwill, so that's great. There's an increase of unearned revenues and deposits in the short term, but there is a decrease in unearned revenues and deposits in the long term. So what this suggests is that there's still money in the pipeline. There's people leaving money with Palantir saying like, okay, you owe me this, that, and the other over the next 12 months or over the next, beyond the 12 months. Note, no debt. There's no debt. So that's good. And this, I feel like it's a moat, and people might disagree, but the accumulated deficit is $5 billion. That is huge. That means that they lost $5 billion to get where they are. So that means if they were in business since 2004, to get here, they had to develop and spend a lot of money, a lot of trial and error, and it just doesn't happen overnight. All right, so the condensed consolidated statement of operations, or the P&L. Here, there's not much to say except revenues have grown 44% to $1.1 billion. They hit a GAAP gross margin of 75%. It's even higher if you consider their adjusted GAAP, which is without stock-based comp. But 75% is pretty good to me. The R&D spend has been lower year over year. Part of this might be explained by the fact that share-based compensation dropped from $1 billion in 2020. It was $1 billion because they went public, and in 2021, 9 months in, it was around 600. R&D spend, when you compare the 9 months, it's still lower, so that's good. Because it means they're spending less in R&D, or they're getting better at it and using better resources or low-cost resources. The next point is that here they have a GAAP net loss of 364 million, which means they lost 364 million dollars. But when you add back the SBC of 611 million, they have a net income of 246. So when you just look at the business and the direction they're heading, they're making money. They're already in a profitable position, and it's only going to get better as SBC tames down, and it's expected to tame down going forward at 4%. So this is a very, very positive news. And this actual adjusted net income is a bit lower. Palantir called for something higher in the 300 millions because they also excluded the taxes that were paid to the government in relation to SBC. But in my opinion, you should include the taxes just because it was actual cash that left the company, and the share-based compensation, it impacted shareholders and not so much the company profits, or the company cash reserves. I would take a pause there, and from a philosophical point of view, and there's a reason why GAAP does say that share-based compensation should be included as an expense, and that's because obviously, if the shareholders gave the cash to the company and said, don't dilute a single share, but here's our contribution, we're giving more cash, and we all stay the same, same pro rata of shares, then what would have happened is that cash would have been paid as payroll expense, and it would have still resulted right here where we were. So either it flowed through as a SBC because it was shares issued, which were later sold on the market, or if it was cash being paid, it would have had the same impact. So that's why Gap treats it that way. But at the same time, truth is, it wasn't a cash expense. It wasn't a cash expense. It was an expense on behalf of shareholders like myself who said, fuck it, fine, don't spend the cash. I'll take a hit on my ownership. I'll get a little bit diluted so that the company can preserve that cash and continue to grow forward. But this is something that you need to think about. And, you know, everyone has their own position. So if you think differently, if you agree with Gap, then go with Gap. If you think, no, I really just care about cash right now, we're in a growth phase, I know that the growth is going to exponentially bypass the SBC, then you'll be okay with it. So it depends on where you sit on the fence. And the cash flow statement. The cash flow statement, there's not much to say except they're already cash flow positive. They actually are doing a great job at generating cash. It's 240 million for 9 months ended. Shyam Sankar already said they're going to hit 400 million by year end. And if you look at the improvement, you know, they were at negative 280 last year, and now they're at 240. That means they improved about $500 million. Cash flow improved $500 million. They dug themselves out of the hole of minus 270 or 280, and then they climbed up to zero, and they exceeded that, and they're going to finish the year at 400 million. So that's big. Here we see that, you know, the company is investing in private companies, SPACs, and other investments. So that's about $200 million. So that's interesting. The debt is settled. So that's good. And, you know, everybody who cries about SBC, you know, don't forget that people who are getting share-based compensation or stock options, they do have to inject cash to get the shares. So in this case, you know, there was a proceeds of 474 million. Which is very interesting. All right, and the last point, it's just a quick one. It's that Palantir is not a one-trick pony. It's not focused. It doesn't have tunnel vision on just one customer. Keep in mind, Palantir is focused on large governments and large commercial institutions or clients. It's not focused on small clients. So since Q4 2020, they were at 139 customers. They finished that year, remember, 139 customers, and they generated $1 billion in revenues. Okay, so it's not something small. It's a huge accomplishment. 139 customers, and they cleared $1 billion in revenues. Now in Q3, they were hitting 203 customers, which means they grew by 46%. They grew their customer list by 46%, which I think is good. Given the fact that how selective they are, how careful they are, they're trying to solve problems and learn from those experiences and add it to their product suite of offerings. It's an important takeaway. It's not a huge takeaway, but I want you to be mindful of that. That Palantir is focused and is proceeding to march forward one step at a time. And there's a reason why they called for 30% growth over the next 5 years. You know, there's a reason why they think they'll hit 4.3 billion by 2025. Be mindful of that. You know, this is a big guidance call. Some people say, ew, oh, it's just 30%, but it's huge given what they're doing, the type of work that they're doing. And this is only going to get better with time. I personally do not think that this is a short-term investment. I think this is a long-term investment that you have to sit on, and the ripple effects, the network effects, the switching costs, all of this will come into motion with time, and only with time that you will see that Palantir can prove that the revenues it generates, the earnings it will generate, will justify its business valuation. What I'm most excited about is that Palantir is involved in solving real world issues, working with governments, working with democracies. Like, I live in Canada, and there's people that I have in my family that live in the States. And, you know, Palantir is working with these nations to offer solutions to real world crisis situations. And I rather, you know, be invested in companies like Palantir than being invested in companies that harvest your data and sell it to the highest bidder, you know? So that's my takeaway. I mean, if you like what you heard, if you like what you saw, you know why now the top 5 bull reasons that I'm invested in Palantir from a qualitative point of view. And no matter what people say, like, okay, well, yeah, there's the SBC, I know that's BS. There's the buying revenues, I know that's BS because we saw it, it's less than 0%. There's the comments that, you know, they're too focused on specific markets, and you know that I don't think is true, because we saw that Palantir with a recent appointment is looking at the Middle East, is looking at Africa, so that's positive. I think that Palantir has a lot to prove and has a lot to offer. It's true that not everyone is going to want to invest in Palantir, because you know they're not catering to any specific group. They're really catering to what they want to do. And I think the only reason they really went public is to continue to retain talent, is to continue to not have to spend an arm and a leg to pay talent in cash, but to, you know, pay them through stock options and use the cash that they have to continue to grow the business. So we will only see where time will take us. But that's all I have to say. If you like what you see, if you like what you heard, then definitely hit the subscribe button. And I will see you on the next video. Okay, thanks.